Good morning and welcome to our December 2025 quarterly macro and markets update featuring our Chief Investment Officer, Michael Dow. I am Julien Frazeau, your Deputy Chief Investment Officer here at Beacon Pointe, and I have the pleasure of serving as your host and moderator for today's discussion. We have a packed agenda, so before we dive in, just a few quick housekeeping notes. We have set aside 90 minutes for this session, and we have more than 90 slides and a broad range of topics to cover, so we will proceed at a steady pace. Many of you have already submitted excellent questions in advance, so thank you for that. But we also encourage you to submit questions during the session via the Q&A box at the bottom of your Zoom screen. Michael will address as many as possible throughout the presentation. And our colleague Nick Coletta is also present on the call to directly answer in the chat any highly specific or technical questions you may have. A full recording of today's webinar will be available within 24 hours at beaconpointe.com/videos, so you can revisit any portion of the conversation at your convenience. So what's on the agenda for today's call? We will begin with a recap of 2025, highlighting the drivers of another solid year of performance and the key forces shaping the economic backdrop. Next, we will turn to the question of bubbles, taking a closer look at conditions in AI and private credit and assessing whether valuation may be running ahead of fundamentals. We will then look at where the Federal Reserve goes from here, considering how inflation and employment dynamics, credibility concerns, and the growth outlook may shape monetary policy in 2026. We will then shift to politics and policies, focusing on the 2026 midterm elections and the potential implication for fiscal priorities, regulations, and market sentiment. And finally, we will conclude with portfolio positioning for 2026, outlining ideas for navigating risk and opportunities as we move into the year ahead. With that, let's get started. Please join me in welcoming our Chief Investment Officer, Michael Dow.
Thank you, Julian, for that thoughtful and complete agenda and introduction. We do have a lot to cover. We're going to jump right in. I always like to start with the overall positioning and the conclusion, because everything we discuss related to macroeconomics and markets comes back to how can we build portfolios that achieve client objectives. So ultimately, that matters. Overall risk taking, equity market risk, bond market risk. This is the conclusion. This is the ultimate end game for us when we talk about macroeconomics and markets. And I just want to highlight the conclusion at the very beginning. So overall risk taking, we're still slightly risk on. The market seems supportive. We don't seem to be heading towards a recession or a credit reversal. That can happen at any time with an exogenous shock, or given the lack of data releases that we've seen from government entities that typically produce those economic reports that can give you a fine point and fine tune where you are. We just haven't had a lot of that in the last 6 or 8 weeks. We're going to get more because of the government shutdown, but we don't have a complete picture. So today's discussion will be done a little bit with a little bit of a haze on the conclusions, given that we don't have all the data that we need. But it will be. We're going to get caught up by the end of this month, so we should be okay heading into 2026. But being slightly risk on, I think, is the appropriate positioning, and we take that risk by increasing our equity exposure by a couple of percent. If you're a 70-30 portfolio, for example, you'll be approximately 73% in equities. And in order to get to 73% without leveraging the portfolio, we have to take it from somewhere. So we're slightly underweight bond market risk. So it's always good to have a strategic allocation to alternatives, and we're going to continue to do that. The conclusion, I think, to begin the presentation is that there's little signs of weakness in the U.S. It's not completely a rosy picture, and again, we're flying a little bit in the haze here. But we don't see any immediate concerns on the horizon because of a few policies that are being implemented that are likely to produce greater deficit spending. That'll give us a short-term sugar high, but after the summer, it's going to be a little more challenging to keep the economy rolling. So we talked about the agenda. So let's jump right into the 2025 market recap. So I mentioned that there was some data releases that haven't been available to us, or more importantly, to the Federal Reserve. The things that the Fed cares about are the BLS labor market report, inflation, core PCE. All of these things have been either canceled or delayed. But the Fed went ahead and lowered interest rates yesterday anyway. They had enough anecdotal evidence to do so. And that gives us a fair amount of confidence that when all of the data gets caught up, what we're presenting today will be a reasonable picture of what's going on. And it's important to mention, as we always do, that the important items for investing, when you're investing other people's money, the most important thing is to focus on the things that actually contribute to the performance that's necessary for you to achieve your objectives. What are the most important things? They are always the same. These don't change. Our views about them or our forecasts for them change, but the framework must remain exactly the same in a disciplined way. Where's the economy at? What part of the business cycle are we in? Are inflation dynamics bubbling up, or are they damping down? Where are corporate profits headed, which has a lot to do with where you are in the business cycle. And ultimately, you're going to marry all of these factors that are important to determine where the stock market and the bond markets are going with what's actually currently being valued or priced in. So comparing all the things on the left to the valuations on the right gets you to where you need to be in order to position portfolios. So where are we in the cycle? Right now, we're saying that we have had a bit of a whiff of stagflation, and that just means slower than expected economic growth. It hasn't been below potential, and inflation has been running a little bit higher than the Fed's 2% target. So now the next step in the process is to figure out where we're going, and that's the most difficult part. We're either going to have a no landing or a reacceleration, and that's our base case for at least the first part of 2026, given the fiscal spending, the fiscal deficit spending, and the sugar high that will result. Or you could get a soft landing, which would be great, or a recession, not so great. All of those are possible, but our base case at this point is we're leaning towards a bit of a no landing or a reacceleration in economic growth in the first part of 2026. So inflation remains elevated. And monetary policy, though, is now near neutral. So the Fed did cut rates yesterday. We're back to a range that appears to be close to neutral. And they're going to start, I think they're going to pause their rate cutting cycle. So the important thing to note, by the way, is the Fed has more than one tool besides just interest rate policy. They can use the balance sheet to affect liquidity conditions and ease or tighten monetary policy by either raising or lowering the size of the Federal Reserve's balance sheet. And they do that by buying and selling securities and injecting liquidity directly into the market. So if balance sheet management has been sort of on a glide path towards a slight tightening, that's over. Quantitative tightening ended last month. And it's quite likely that we will see either a trend growth in the balance sheet over the next year or two, or even slightly higher than trend growth as the Federal Reserve deals with some liquidity issues, particularly around year end. So look for the balance sheet of the Fed to take a bigger policy role in 2026. Corporate profits have been resilient. They're going to remain resilient, especially driven by the big mega cap technology companies that are literally printing money. So resilient corporate profits, always good for the equity market, and we should expect to see that unless we get a significant slowdown. And finally, valuations are stretched in some areas, but not so much in others, and that's why it's important for us to continue to be aware of where and be selective in the risk taking that we're seeking to achieve in the portfolio. So the final thing I want to say is solving for the proper equation is beating a risk profile benchmark on a risk-adjusted basis is absolutely key. That's the equation we're trying to solve for. It's not to achieve, high absolute returns. That's not possible when the market's not with you. So we want to look at the benchmark that you've established as your risk profile, and we want to quantify that and make sure that we're going to achieve the objectives that are embedded either in your financial plan or in your investment policy statement. So finally, and moving into a review of 2025, how's the stock market been doing? Well, if you're an international stock market investor, you're up 30%. This is the MSCI All Country World Index X the US, up 30 versus the US up 19%. It's been a long time since the foreign bond markets did better than the US bond markets. 2022, which was a terrible year for global equities, the MSCI ACWI ex-US or foreign non-US equities did slightly better in a down year, and the prior year that they did that foreign stocks did better than U.S. equities was actually about 13 years ago, back in 2012. So this is a very rare occurrence, but it argues for remaining diversified. So great year for international equities, on top of a great year for U.S. equities. 19 is still 2 or 3 times the expected longer-term return for equities. Interest rates have come down about 50 basis points on 10-year yields and about 70 basis points year to date on 2-year yields. So good environment for bond portfolios. As interest rates come down, bond prices go up. So a combined bond and stock portfolio, which we'll see in the next 2 slides, has done very well over most of the last 3 years since the rather horrid year of 2022. We also look at volatility. We've had a couple of spikes towards in the end of the 3rd quarter, beginning of the 4th quarter, related to a China tariff situation and government shutdowns. And then there was a bit of a hiccup when corporate earnings were announced. So volatility is down year over year. That's a sign potentially of complacency. One of the things Julian and Nick and I talk about quite a bit is that when volatility spikes, it's generally a good opportunity to move into and to buy equities. When volatility is low, it tends to indicate that maybe the market's just a little bit too sanguine and that potentially caution is warranted. Finally, commodities and Bitcoin, and then we'll go to the questions. Gold is up 61% year to date after being up to 25 or 30% in 2024. Bitcoin down has come down hard in the 4th quarter, down 4% year over year, and oil is down 20%. So all in all, pretty darn good year. Julian, do you have a question?
Yes, I was going to ask a question. Actually, Nick answered it privately, but I think the audience will be interested as well. Is like, how does the Fed and how do we do and all the market participants do their job when there's no more macro data provided for quarter because of the government shutdown?
Yeah, it's very hard, and we're going to talk a little bit about it. The Fed has a lot of what I would call boots on the ground in the 12 regional banks around the United States, and they're getting anecdotal data even without the federal government data that we as market participants rely on. There's also other private data sources that folks that the Federal Reserve Board can look at. But I think a combination of data sources outside the U.S. and or outside the federal government that are primarily driven by the regional banks, heads of research, they've got a lot of resources around the country. And in addition, some private sources will get them to the point where they can at least make judgments. We're going to get all caught up here. This was government shutdown was a temporary situation. Julian, follow up?
And just a quick follow-up, I guess, the flow will resume. And can we still trust the data coming out of the agencies?
Yes, you can absolutely trust the data coming out of the agencies. For the most part, they're headed by nonpartisan, unbiased professional economists with staffs that are doing the best they can with the information that's available to them. So there is no alternative. And for the most part, this isn't Greece, okay? Where 15, 17 years ago now, there was an issue with Greece entering the Eurozone by fudging some of the numbers. That's not what we have here. What we have here is a temporary data vacuum that will be completely filled, and we can move on from it starting in 2026. Okay. Looking at the U.S. dollar, which we're going to talk about equity markets, we're going to talk about bond markets, but I thought I'd start with the U.S. dollar. It reached a peak early in January of 2025, and subsequent to that is down about 9 or 10%. It had a fall of about 11% at the low, but it started to recover. The US dollar has a lot to do with why international equities are outperforming the US. We invest in international equities in an unhedged fashion. So as the dollar declines, if the dollar declines 5% or 10%, you can just add that to the return of the local currency return for international equities. And that's, by the way, approximately the difference. It's the US dollar declining by 10% that has allowed international equities to outperform by about 10% in 2025. There's a question about corporate profits. Julian or Nick, the expectations for 2026 are, high single digits. But they're always positive. We're going to talk about some of the investment banks' price targets for the S&P, and to affirm they're all above the current levels. So I think what we want to do is, look back and see that corporate profits have been incredibly solid, very durable, highly concentrated in tech companies. 12-month forward S&P earnings are at about 11% growth rate, and that's quite impressive. Will we actually get there? Well, we'll talk about that in December of 2026 when we do this meeting again. But the idea that the investment banks are positive on the economy and positive on the stock market is not a big surprise. And by the way, the U.S. dollar is down versus a basket of our trade-weighted partners. This is the DXY index, and it's primarily made up of the euro and to a lesser extent other European, non-European currencies. So the pound, sterling, Japanese yen, and others. So it's basically trade weighted, and it's a pretty good estimate of what you'd want to know in terms of how the dollar's doing on a relative basis versus the folks that we're actually trading with, which is why you want to know how Forex is moving, because that tells you about trade flows going forward. Quickly now, 2025 is in the red. When I say in the red, just the red color, it's clearly in the green. 17%, almost 18% for the S&P, and about 30%, whether you're talking about developed non-US or you're talking about emerging market non-US. The Russell 1000 growth back in 2023, which is the blue, big year again in 2024, just not as big, also very solid in 2025. Value lagging. This is we're going to talk a lot about the mega cap tech companies driven solely by and in large part by those companies. Small cap kind of on par with value. Looking at the bond market and looking at cash has had a nice 3-year run, 4 to 5% on cash, but these numbers are going to come down as the Federal Reserve is lowering rates, and that'll make bonds more attractive as a result. Municipal bonds lagging the broader bond market, including treasuries, corporates, and mortgage securities, which is comprised the U.S. aggregate. They had a tough first half of the year, and they've started to recover, but they haven't been able to make up for what was a very difficult February, March, and April, as there was concerns about whether or not municipals would be federally tax deductible. That turned out to be kind of nonsense. The riskier bond markets, emerging market debt and U.S. high yield, did better than the investment grade bond markets in 2025. So it's been a good year to own a diversified portfolio, both stocks and bonds doing very well. Again, looking at the U.S. dollar year to date now, the number is -8. Looking at 2024, the dollar was actually up 8% as U.S. interest rate differentials were a little bit more favorable. They've become less favorable. That is, the Federal Reserve is lowering interest rates, and other of our trade partners are not. Interest rates, for example, in Japan are going up. Eurozone is not cutting rates, certainly not as fast as the U.S. So it is these factors, the trade balances and the changes in the short-term interest rate environment of our trade partners that has an effect on the U.S. dollar. Gold, again, 3 really good years, pretty amazing, 27% in 2024 and 61%. This is an issue that's being driven by, or return profile, it's being driven by issues with debasement of the U.S. dollar or concerns about inflation here in the U.S. That might be, in my opinion, slightly overblown. It's also combined with central banks outside the United States buying gold. A couple of more interesting points, then I'll come back to you, Julian. Bitcoin year to date's down a couple percent, but it was up 300% and 140% in the prior 2 years. And here's the most important chart of the last three. Everyone should be invested in a balanced, diversified portfolio, 50% equities, 50% bonds, or 60-40, 70-30. And 2025 has been a great year for a policy portfolio investor. That's what a 60-40 or 70-30 or 50-50 is, a policy portfolio. If you're in a policy portfolio 60-40, you're up 16% year to date, 11% in the prior year, and 15.5% back in 2023. These are 3 excellent years to be investors. Both bonds and stocks helped. It was a great opportunity to have a diversified portfolio and to stay invested. Folks that kind of got nervous after 2022 and went to cash or decided not to be a participant have left a significant amount of returns on the table. It's very rare to see this kind of a return profile, so we don't expect it going forward. Julian, did you have a question?
Yeah, there were a few questions we received by email about gold, and now you're highlighting the performance in 2025. So just maybe it's a good time to remind people how we think about it in terms of asset allocation.
It's not a strategic allocation. And the reason it isn't is we're trying to solve for a particular equation. I mentioned this at the front end. It's not part of your benchmark. If you're 70-30, your benchmark is 70% stocks and 30% bonds. That's the benchmark we need to beat to achieve your investment objectives. There's a lot of other things you could invest in, and I call them shiny objects, and gold would be, of course, the shiniest. But we don't have an information advantage. Gold trades on both technical, fundamental, momentum, real interest rate factors here in the US, inflation dynamics, a lot of which can't be properly forecasted or forecasted with a high degree of confidence. And the only reason to buy something and to include it in your portfolio is because we think we have an information advantage. And very few people, I don't know anybody who has a durable information advantage. Of course, there's some folks out there that were predicting gold would do very well in 2024 and 2025, but they've also been predicting that in years when gold didn't move at all or was down considerably. So you'll always be able to find somebody who was right, but sometimes it's like a stopped clock. I'm not so sure that trying to find the next investment theme or to try to find the next hot commodity or hot stock is a useful way to try to achieve longer term investment objectives. So we don't do it because we don't think we or very few people have an information advantage, and that's why we don't have it as a part of our strategic allocation. Doesn't mean we wouldn't own it. We've actually had an allocation to gold back when inflation expectations were very low. That was 5 years ago, but it's the last time we had a tactical allocation to gold. Okay, moving on now because there's a lot to get through. I always include 3 or 4 of the next slides to set the stage for the global economic environment. The JP Morgan Global Purchasing Managers Indices, there's one for services and there's one for manufacturing, are a pretty good indicator in real time of how things are going globally from an economic activity perspective. Global services PMI well above the neutral line of 50 at 53.3, and even global manufacturing is in positive territory. So this indicates that the global economy is expanding. And looking at the composite purchasing manager indices across a more granular view, these are the global figures, but here's by region and country. I mean, things are looking pretty green and greenish yellow. And that's good. From a Z-score perspective, things are moving in the right direction. The Eurozone looks particularly solid. They haven't had any, data issues, and the PMI is, pretty timely. So it doesn't look too bad. The EMs are the only place that look a little slightly orange, and that I would consider that neutral. Those are kind of like neutral readings, but everything else is looking pretty positive. So both global manufacturing and global servicing are expanding, and that's typically what you see when you have a preponderance of rate cuts. So you've had a lot of rate cuts in both developed. Emerging markets are orange, developed markets are blue. there's been a total of 155 plus rate cuts in the last 12 months and 25 rate cuts in the last 3 months across developed and emerging. And I'll just go back here and see, we get this kind of like slowish kind of feeling in emerging markets. Well, the emerging economies in particular are now increasing their rate cutting cycle in order to support growth. And you can see that in the last 3 months. No hikes in EM, a couple of hikes in develop, but a lot of rate cutting going on. And this is the overall average, and this is two different scales. You've got emerging markets going from a peak of about 9.3 back in early 2024 to a couple 150 basis points lower, and you've seen a pretty dramatic rate cutting cycle that began in sort of late 2023, early 2024. That's seen developed market central banks on average cut their rates from 4 to 2. So global economic activity is supported well when you've got global central banks in rate cutting mode, and that's what we're seeing now. So I'm going to leave this as kind of red. I just want to highlight that some of this data, which was supposed to be in the 2025 recap section, gives you a preview of what we're going to talk about at the end, which is an outlook for the outlook for 2026. U.S. GDP, about the same, 2% looks like the number for 2025. The forecast from blue chip economists is 2% for 2026. CPI, about the same. So steady across the board. Not a lot of, no forecast for the end of the year for some of the market data, but the unemployment rate ticking up very slightly. Kind of a disturbing budget deficit number, but it's stimulative. When you've got a budget deficit that's growing, it's bad for national debt levels, but it's good for the short-term economic activity. So Nick has got this identified as stimulative, and rightly so. Taking a little bit of a closer look at U.S. Real GDP components, it's composed of C plus G plus I plus X. That's consumer plus government plus private investment plus net exports. And most everything you got going here is stimulative with this kind of a decline, decreasing, meaning it's negative for GDP growth because you've got increasing exports. So it's a pretty benign environment for U.S. economic growth. And I just want to highlight the key questions for 2026. I think the most important thing is, will we continue to see resilient global growth? And that might have a fair amount to do with the second question, which is, can the artificial intelligence supercycle persist? And we've heard a lot of talk about how credit markets aren't offering much in the way of compensation. So what are the headwinds to credit markets, both public and private credit? And can the Fed maintain their independence and land the plane? What I mean by landing the plane is get to normalization of interest rates without causing a recession or causing a reacceleration that would require a Fed rate hike to damp down inflation. So that's what we're thinking about. There's a lot of detail in here. This is the GDP forecast for 2026 by quarters, and what you see here is it's pretty much potential GDP growth at 2% as far as the eye can see. Nothing to see here. I doubt very seriously if we're going to get this consistent return profile for GDP growth. I can't imagine, but that's what the current forecast is. In terms of personal consumption expenditures or inflation, I mean, inflation seems to be stalled at higher than the Fed's target, but I think that's okay. And I'm going to say this because we'll talk about it towards the end of the presentation, but one of the issues facing the economy, particularly the U.S. economy, is the high levels of debt. And inflation is the best thing you can do. It's kind of like acid, pouring acid on a pile of debt. Inflation tends to dissolve it faster than and more effectively than just about any other policy mix you can come up with, especially if you're a politician and you want to get reelected. No politician gets reelected when they say, we're going to cut services and we're going to raise your taxes so we can balance the budget. So the best way to deal with the debt is generally to let inflation run hot. So I don't think this is a problem for policymakers. In fact, I think they would welcome a slightly higher than the Fed's 2% target of inflation. And if it took a year or two to get back down to 2, that'll just melt away some of the debt as we repay debt with inflated nominal dollars. Problem is, we got to stop increasing budget deficits. So this really works best. Inflation works best to reduce the real debt burden best when you actually have something closer to a balanced budget, which we don't have. The forecast for Fed, is for normalization of rates. I think we're almost there. Another cut or two, and we'll be at what we think is our star and what the Fed thinks is our star. At least our understanding of what the Fed believes is our star. So that's a pretty good summary of what we've seen and what's going on. I think it's I mentioned that this is by the way, this is GDP. We had this kind of averaging thing for first and second quarter. We had a lot of imports being pulled forward in the first quarter that were not that wasn't repeated in the second quarter. So you should just average these two and you get to 2% growth plus or minus. This is kind of a timing thing. So I don't think there's much information content in there. It was related to the concern of tariffs causing some disruption in imports, so they were pulled forward in the first quarter. So this is the quarterly GDP forecast. Here in the first quarter, we expect to see quite a bit of a boost from tax refunds from One Big Beautiful Bill. There's other things that are likely to be positive for growth, including business fixed investment. As we implement faster accelerated depreciation methods, that should prove positive for business fixed. So there's a lot of things in the One Big Beautiful Bill that are likely to be growth positive in the first half of the year. Not surprisingly, there's a midterm election coming up in November, so this is not unusual to try to use the tools of fiscal policy in order to boost the economy heading into the election. Every administration does it. This one's done it more or most aggressively than we've seen, but it's likely to work. Works every time. So that's what's happening, and it's a big deal for 2026 when you're thinking about themes. The themes of 2026 have to include the desire of the current administration to retain control of the House. The House of Representatives is likely to be a bit of a battleground. The Senate is going to be a little more challenging for the Democrats to regain. We'll talk more about that when we get to politics. But to retain control of the House, the economy can't be in a recession come October, November. So policymakers in power will do the best they can. I'm just going to suggest that one of the things you might want to look at besides GDP is final sales to domestic purchasers. Final sales to domestic purchasers takes out the more volatile components of GDP, including inventories, which is the most volatile component, and net exports. It's basically domestic purchases, and it's a little more what I would call it's a more stable indicator, and it's probably a more durable indicator of the strength of the economy. For second quarter, we got a pretty nice final sales number. We just don't know what the number is for the third quarter. Putting it all together, the chance of a recession in the next 12 months is still about 1.5 times the average probability of a recession, which is close to 20%, call it 15 to 20%. It's at 30% right now per blue chip economist. So it's elevated versus history, but it's come down since we saw what we're calling the peak policy uncertainty period, which began in late February with the announcements of the Liberation Day tariffs, and then the actual the preview of the Liberation Day tariffs in February, and the actual announcement in the first couple of days of April caused some pretty severe volatility in both stock and bond markets. And that policy uncertainty caused most economists, and our team included, to conclude that we might actually have an increasing chance of a recession in the second half. Never materialized, or at least we don't think it has. Again, there is a little bit of uncertainty about the data right now, but things look on track. We look at financial conditions as real-time indicators of the cost of funding here in the U.S. economy to see what economic growth prospects are for the next 2 to 4 quarters. And the financing conditions, or financial conditions, or we call them FinCon here, are really very solid. Higher equity markets, lower funding costs for corporations, lower equity market volatility, lower 10-year yields, and lower Fed funds. All of these things combine to make investment in the U.S. economy cheaper. That is, it's a lower hurdle rate for making an investment. And so CFOs are looking at their financial conditions and saying, well, we can make this investment. So they're going out and they're going to be buying property, plant, and equipment, hiring, et cetera, because financial conditions are in the green. We're not exactly sure where many of the leading economic indicators are because much of this data hasn't been updated, but sentiment indicators are, and home builder sentiment is not great, and consumer sentiment, we're going to see on the next slide, is at all-time lows. So consumer sentiment here printed literally at an all-time low. Consumers feel bad. And I think it's mostly related to affordability. And just circling back to the November 3rd midterm elections, I think between now and then, you're going to hear the word affordability. If you did a word search, affordability is probably going to be the big one when it comes to how do we think about the November 3rd election outcome. If the Republican Party can work through the issues and try to figure out how to increase affordability for housing, get prices down for groceries and things, then they're going to do very well. If they can't, if the Democrats can paint the current economic conditions and the inflation that we're seeing and the prices of mortgages and auto loans and consumer loans, and basically make the Republicans responsible for that, which they're not entirely. No government is entirely responsible for the economic outlook, but we're just talking about how things actually really work in the real world, and this is how they really work in the real world. What you see is it'll be a campaign rhetoric heading into November 3rd, and it'll be all about affordability. And right now, consumers do feel bad. If this number doesn't turn back up, it's not likely to be good for the administration. So here's future. That was current conditions. The future doesn't look very bright for consumers either.
Michael, there's a good question about how
Yeah, I
sharp
see
down.
it.
No, you
I
see it.
see
All right.
that. Yeah, and the answer is we don't know. The answer is generally, for example, on future is a little better than a better predictor of recessions than current conditions. And this number has been hovering in what I would call the recession signal area. It's a couple of things. Could be folks in particular socioeconomic buckets that are responding at a greater level, pushing this number below. I mean, it's a K-shaped economy we're in right now. If you're in the upper income brackets, you're doing just fine and you're spending money, and that's why Black Friday was such a great was a pretty good result. Consumers are spending even though they feel bad. So it might be that the higher upper income levels don't feel so bad, aren't responding to the reports, and are buying things on Black Friday. That's the only explanation I can think of. Nick, was there anything else that we discussed earlier that you would add to that?
It really comes down to the K-shaped economy, and then they change the way that they do these consumer surveys to be basically over email. So when they change that, they've been getting consistently a little bit more pessimistic over time, but that could really be the only two explanatory variables that we can think of right now.
It's actually a bit of a puzzle. Julian?
I was going to ask, I suppose that it's not dollar weighted, right? So the consumer who has $100 to spend or the one that has 10,000 is weighted the same in the survey.
Yeah, so but yeah, K-shaped economy, basically. If you've got the money, you're spending it. If you don't, you feel bad. Is the kind of the way it feels. Looking at the labor market, it's a mixed bag. The Fed is highly focused on the developments in the labor market. And by the way, consumer confidence is highly linked to the unemployment rate. If you've got a job, you're confident. If you don't, you don't. You're not. So watching the labor market is not just an academic exercise. The Federal Reserve is laser beam focused on the unemployment rate ticking up another couple of tenths this year from 3.9 to 4. Let's see, beginning of the year probably 4.1, now to 4.4. That's the highest unemployment rate we've seen, but it's still much below historical averages and probably right at or below NAIRU. So it's not that's the non-accelerating inflation rate of unemployment, higher than the NAIRU, and it tends to push inflation up. Lower than the NAIRU tends to push inflation down. So it's a bit of a mixed bag, but the unemployment rate is ticking up slightly. Again, not a concern at this point, but the Fed lowered rates yesterday in large part because they're concerned about the future developments, future developments in the labor market. Let's see, inflation. We don't have a data release since September. October was canceled, so we'll get a data release on CPI. Again, the Fed's got a lot of anecdotal and private market sources and they made the right decision, I think, yesterday to get interest rates a little more normalized because the data suggested it, at least the data points we saw, but we're still above the Fed's 2% target by a fair bit. Again, that might be okay given the size of the debt levels. Here's some market-based inflation expectations. And again, the most important thing for the Federal Reserve is to keep this gray line, the one that's printing at 235, that's 2.35%. That's the number that the market is telling you they believe inflation will be between years 2031 and 2036. That's 5-year forward. So 5 years from now is 2031. 5 years from 2031 is 2036. Boom. That's the inflation rate that the market's telling you. The market is telling you the inflation rate between now and 2031, that's 5-year forward, is 2.32. These numbers are Fed credibility indicators. When these things get high, like they did back in April of 2022, the Fed absolutely had to raise interest rates. So again, if you're looking to see what the Fed's going to do, and the reason they lowered interest rates yesterday is because inflation expectations remain pretty well anchored. So let's talk about prices and affordability. I think that's going to be a big deal for 2026, as I mentioned. Where are we seeing issues? Food, groceries, energy commodities, transportation commodities, household furnishings and supplies. Wherever you see red here, and services and medical care. Wherever you see red, these are the things that are pocketbook. These are kitchen table type issues that are likely going to be challenging for the incumbent party come November if affordability doesn't become more affordable. You know what I mean? So we'll get more data on this in the next week or so as the CPI releases catch up to the government shutdown. Julian.
Yeah, Michael, we're pretty much halfway through our webinar already, so I guess we can move to the next section. And we got a lot of questions on bubbles.
Yeah, let's talk
so maybe we
about
can we can start by explaining what's the definition and where we think there might be some bubbles, and AI is the obvious candidate.
I don't think you're in a bubble until you're removed from it. So I attended a seminar about 12 years ago at the Bank de France, actually, that was talking about bubbles and how to resolve them and what the policy implications are. It was sponsored by the European Central Bank and the University of Chicago. And the conclusion of that is basically, I think, now sort of canon, which is you don't know you're in a bubble till after, because a bubble suggests that you're making unproductive investments and you're spending way too much on investment, and those investments never get translated into productive capital where you generate earnings. That's a bubble, I think, is a pretty good definition of a bubble. And there's some characteristics of bubbles that we could talk about. It's not a bubble to say that on this slide. These are by the way, I've circled the Mag 10. These are the top 10 companies. Are these companies in a bubble? Is Tesla, Meta, Alphabet, Amazon? We don't know. The answer is we don't know, but we've done some analysis, which we're going to dig into right now. But know this, if you look back in 1985, these were the top 10 companies, and they had a total market cap of 250 billion. Now in 2025, 40 years later, there's not one company that was in the top 10 in any point in the last 35 years that remains in the top 10, with the exception of Microsoft. And that's kind of amazing that they've been there. Most of these companies didn't hardly exist 20 years ago. And that's a feature of a dynamic U.S. economy that's different than most other economies. We have the ability to create these companies that are, world beaters in their respective areas. They're doing a lot of business with each other now, which is causing their corporate profits to increase amongst each other. That's a potential issue. We'll talk about that in a second, but maybe we'll just shoot to the next slide and say, here's why you went from, 10 companies at 250 billion. Now the top 10 companies are at 20 billion. And the reason is because of the returns for Apple, Google, Microsoft, Amazon, NVIDIA, and Meta. So the Magnificent Seven stocks have enjoyed a magnificent run of returns over the last year or two. We've included in the orange, by the way, what happened during the Liberation Day, just to show that, you know, these stocks don't go straight up. But in 2024, NVIDIA was up 170%. And in 2025, which is in the red, you got 36%. But Google's the big winner here for a lot of the strategic decisions that they've made related to investments in chips and training and OpenAI type and large learning models, not OpenAI in particular. Gemini, I think, is the Google model. Is that right, Nick? Yeah, I think that's right.
Yeah,
Anyway,
that's correct.
Yeah, so you've got a lot of these companies that we're all very familiar with that are just absolutely tunning it in terms of their stock market performance. If you look at the S&P, they're all kind of, you know, some of them are crushing the S&P. But if you look at the S&P equal weight, which basically solves for the market cap weight, you'd only be up 10% if you kind of excluded some of the effects of these larger companies. Since August of 2022, in just under 3.5 years, the Mag 7 is up almost 200%. This is the most amazing thing about this chart isn't that the Mag 7 is up 200%. It's that the S&P is up 70% in 3 years. That's an amazing number. That's a very, very big number. To go 2.5 times that for a group of 7 stocks is kind of I can't even fathom it. It's such an amazing kind of return profile. What it has meant, though, is that now there's a high concentration. The top 7 stocks, the Magnificent 7 weight in the S&P 500, as of yesterday, they make up 35%. There's 500 stocks in the S&P 500, and 7 of them account for 1/3, more than 1/3 of the market weight. This has implications for managers trying to beat a benchmark. It has implications for concentration risk in technology. It just makes it a lot more challenging for asset allocators like Beacon Point and frankly, growth managers, asset managers who are focused on the Russell 1000 growth of the NASDAQ to actually beat the benchmark, especially when you look at things like valuation metrics. So we look at price to earnings and price to sales as interesting valuation metrics. The S&P 500, this is forward earnings, 25 times is the price of the current S&P 500. Again, if you look at it on an equal weight basis, it's about 20% lower than that at 20 times. But Apple, Google, Microsoft, Amazon, NVIDIA, they're all trading for the most part at a premium. And most of the NASDAQs being at 36 times is being dragged up by Tesla, which is a complete and total outlier at 225 times. So there's a valuation issue potentially. However, again, these companies are making a lot of money, partly because they're doing a lot of business with each other. This is a kind of a messy graph, but it suggests that there's a bit of an ecosystem here that where software and hardware investments, actual equity stakes, contracting for services, and frankly, staking new companies in a venture capital environment. It's a lot of it is happening all in the same ecosystem, and that could be an issue. And it's something that folks have raised as an issue. And again, you just don't know. You just don't know if it's going to be a bubble because it'll take quarters to determine whether all of this investment, and when I say investment, I mean capital expenditure. Here's the capital expenditure for the trailing 12 months CapEx by quarter. So over the last 12, looking back from September 30, these 5 companies alone generated $350 billion they spent $350 billion on CapEx. These are not CapEx light companies. These are not capital light companies anymore. They were cap light companies, and now they're kind of becoming something different, something more akin to an industrial company as opposed to services/technology company that's super scalable and could command a very high PE ratio. I want to suggest something here. This is a regression line that Nick did, that if you regress the CapEx spend, so if you're spending 30, 40, 50% of your CapEx, by the way, Mag 7, closer to 50, 55% of EBITDA on CapEx, generally, the companies that spend a lot on CapEx have a lower price to earnings ratio. That's what this negatively sloped line is telling you. So you should see CapEx, or price earnings ratios, something on the order of, for these companies, if you spend 35%, you should see a PE ratio of 17 times. Well, again, this isn't determinative, but it's an interesting point. If you spend 60% on CapEx, maybe you should be running a 10 or 12% PE instead of a 30 times PE. So is this evidence for a bubble? Again, nothing can tell you you're in a bubble until you're out of it. So we looked at price to earnings and price to sales, and both suggest there might be cause for concern. And by the way, here at Beacon Point, we're looking at the fundamentals all the time. Our job is to figure out not necessarily if there's a bubble, but whether or not there's value in a particular investment. And sometimes those two things are exactly the same. Right now, would we recommend putting a lot of money into the hyperscalers? Probably not. Would we want to get kind of like index-like returns? Yes, we would, and that's why we're neutral growth stocks, overweight value stocks, because should there be a re-rating of the valuations of some of these companies, it's likely to hit the Metas and the Apples and the Amazons and the Googles of the world a little bit harder. But the fundamentals right now are pretty compelling to suggest that some of these valuations could possibly be justified by future productivity gains. 12-month sales of $2 trillion for these 5 companies. 700 billion of EBITDA for these 5 companies. These are numbers that are off the charts, and they are highlighted by NVIDIA. Let's just look at NVIDIA alone. Back in 2017, NVIDIA had an EBITDA growth rate of 60%. Still amazing, but they were a very small company. They had an EBITDA of like 2 billion, and a surprise, this is the surprise number when they reported their earnings, of a 0.23. So you got a $2.5 billion EBITDA company here. Well, by 2024, they were closer to 38 billion. By the end of this year, they'll be closer to a $90 billion EBITDA company. The expectation in 2026 is for 135 billion in EBITDA, and maybe 4 times that by 2029. So these, now again, those could prove to be highly optimistic estimates for EBITDA. But that's where it stands right now. And most of these companies, they've got the cash flow, as we've discussed. EBITDA is very high, cash flow is very high. They haven't had to go out on a borrowing spree, but I just want to highlight, when you're thinking about equity investing, it's also good to know what's on the right side of the balance sheet, which is the debt. And most of these companies, between 2023 and 2025, Apple has actually been able to reduce debt with their cash flow. Amazon has increased it slightly. It's really Microsoft, Meta, and to a lesser extent, Google that have increased the size of their long-term debt. These are billions of dollars. So Microsoft went from 70 billion in debt to 104 billion in debt. Meta went from 35 to 48. They paid some down and then did the biggest bond deal in history on October 30th when they brought 30 billion. It's a record-breaking size. They brought a 40-year deal at like 30-year treasuries plus 110. It's a very cheap financing. So these companies are high quality. They're generating a lot of cash flow. They can come to the bond market if they want to, and they can get money at a very cheap rate. So that's the AI discussion. Any quick questions or thoughts, Nick, Julian, that we want to talk about? Questions? All right, let's go to private credit. So what is the deal with private credit? It's a very fast-growing business. Private credit 25 years ago was a $40 billion business. There's 2.2 trillion now invested. It's got a pretty nice cumulative average growth rate, CAGR. Private credit's growing, and it's growing because of a regulatory issue. You got the Dodd-Frank bill in particular, and Sarbanes-Oxley and the Great Financial Crisis. Those things took its toll on bank lending. The regulatory environment made it non-economical for banks to actually lend money to companies that were smaller than the biggest companies. And interestingly, the small companies are the ones that need financing. And if you can't go to the bank, the good news is the very responsive and dynamic and entrepreneurial U.S. economy will fill that gap with private credit, and that's what they did. So the private credit business has grown about 13% over the last 14 or 15 years. But the public debt markets, both investment grade here and high yield, have also grown and the public debt market for investment grade bonds, $7.5 trillion. So you got a $9 trillion public debt market and a $2 trillion private debt market, and they're both growing very quickly. So the fact that they've grown this quickly, and by the way, these numbers depend on how you actually define private credit. I've seen other numbers that suggest the public debt markets have grown faster than the private debt market. So just by saying there's so much money going into private credit, that suggests that there's overvaluation or a bubble in private credit. That's not the case. You got to look at the overall debt growth and debt, and public debt markets are growing very fast too. The reason you've seen this substantial growth rate is because, frankly, if you look at a risk-return scale, the returns on direct lending as measured by the Cliffwater Direct Lending Index, or the CDLI, are pretty darn attractive. Relatively low risk, relatively high returns. And I just note for the record that it's only private. This is private direct lending. This is private equity that are above what I would call the security market line. Russell 3000 is public stocks. Public bonds are here. You could actually tilt this line maybe a little bit, this way from a slope perspective, and that would make the private markets look even more attractive. So this isn't an advertisement for private markets, but it might as well be, because frankly they're pretty attractive. Julian?
I guess I was going to say this is the perfect illustration of what we call the illiquidity premium. You're being compensated for taking illiquidity risk.
Totally agree. There has to be some reason that these asset classes are doing better. And as Julian points out, there's an illiquidity risk premium that you should count on. It's a durable market failure or market inefficiency. That, along with these types of securities, these loans and these equity investments, are a little more complicated. So there's a complexity risk premium too. So there's a reason for it. We understand it. It's why we are pretty bullish, generally speaking, on private markets. Private market investments, by the way, this is a 10-year history. You've got to look at longer periods. For the last 3 years, public markets have dominated private market assets. And that's because private market assets don't trade minute by minute. They are priced on a fundamental or intrinsic value basis on a quarterly or monthly basis. So they have a much smoother return profile. And so they won't ever keep up with a very swift and durable equity market. If the S&P is up 100% in the last 3 years, there's no way private markets are going to keep up. They just don't. However, over longer periods of time, they tend to do very well because they do have higher expected return and lower expected vol, which are very attractive characteristics for a portfolio. Here's where we might suggest that, this is how I look at private credit and how I look at other credit markets. It's not so much that a lot of money has flown into, has gone into them. It's not so. That is a key. That's something to consider because it might say something about underwriting standards. I want to look at the compensation for taking default risk. And the compensation for taking default risk is measured by something called the current spread over the risk-free rate. So for example, in private credit, the current yield on private credit is 9.4%, which is composed of 2 items: the risk-free rate for private credit, which is short-term T-bills, which on average over the last 12 months have been about 4.5%. 4.5% plus 5% gets you to the 944 here. That's the composition of the yield. It's the risk-free rate plus the spread. And the spread is compensation for default risk. You can look at the same decomposition for U.S. high-yield corporate bonds, yielding 670, and investment-grade corporate bonds yielding 480. I just want to make this point very clearly. It's not the absolute yield measure that matters. It's the spread that matters, because the risk-free rate is about the same across all of these asset classes. You need to be compensated for the risks you're taking, and that compensation is measured by spread. Here's the history of the private credit spread. Here's the history of the much more volatile U.S. high-yield corporate spread. Here's the history of the lower spreads because they're less risky. Investment-grade corporate bond spread, you see spikes during COVID. They're off the chart here for high yield. But the trend here is pretty straightforward and pretty obvious. The last 10 years or so, high yield or private credit spreads have averaged at 6%, and they're at 5% now. So the fact that private credit spreads are tighter than they have been historically is the thing that makes me pause when thinking about private credit. Do I think there's an issue on the horizon? Here's a point that has to be made. There will be winners and there will be losers in the managers of private credit. The folks that have been doing it for a long time and have strong underwriting have diversified portfolios that know how to manage credit, that don't take a lot of leverage, and that focus on the senior debt, first lien, as opposed to the second or the subordinated debt. These are the factors that matter when trying to assess how a manager will do when we have the next credit cycle. And we will have a credit cycle. Private credit has had 10% returns for the last 5 years. That's why everyone's flocking to them. They have a great risk-reward profile. That's why everyone is moving to private credit. Is it a bad place to be now? Not saying it is. Is the compensation for risk-taking lower now than it was 2 years ago? Yes, it is. Are there other areas of the credit markets that we should be thinking about? The answer is yes. Things like infrastructure, asset-backed lending. These areas don't have the same kind of what I would call spread compression profile, and that makes them more attractive. Any questions about what we called our bubble section? We're at the 1 hour mark right now.
No, I think we can move to the next section. We still have quite a lot to cover, actually.
All right, let's move on then. Politics and policies. Let's do a pretty quick scorecard. These are the 5 or 6. These are the 6 major policy priorities of the administration related to immigration, trade, cost-cutting, Federal Reserve policy and independence, taxes, and deregulation. Looking at all of these, we can say borders tightened, tariff revenues increased. We're going to get a Supreme Court decision on the legality of using the IEPA, which is the International Emergency Economic Act, to see if that's an appropriate basis for the tariffs. If it's not, the administration, I believe, will find another way to collect tariff revenue and then either use it to pay down the debt, which would be the right thing to do, or to reduce the budget deficit. But given this is an election year, there's talk of maybe a tariff bonus being sent to consumers, which would also probably improve the confidence levels that we've seen are very low levels. Cost cutting, I'm not sure. The cost cutting was supposed to reduce the deficit, but that didn't happen. So I give it an X. We're not sure where we are on the pressure on Fed. The Supreme Court is going to decide the Lisa Cook case sometime in January. And that will say a lot. Is the Fed different than other independent agencies? You bet it is. And I think the Supreme Court will see it that way as well, and we'll see what the poly markets say about it. Taxes are the big one. Lower tax rates. This, moving forward means everyone's going to get a decent tax refund in 2026 for their 2025 taxes. Plus, all these accelerated depreciation tax benefits are going to cause corporate profits to be higher, and that's a big green check. That's a done deal. OB3 passed in July. And then you've got, we're still working on how to unfreeze some of the regulatory constraints in finance and energy that are likely to unleash more investment and perhaps lower the costs of energy. That would be a plus, but that hasn't gotten as much traction as some of the other policy priorities. So growth negative policies might be these on top, but they're being overwhelmed currently by the growth positive policy priorities on the bottom. And I'm not going to belabor it, but everything that we talk about should be viewed in the context of the November 3rd midterm elections and the desire of any current administration to want to retain power. What do we got here? This is the estimated tariff rates. So tariffs were supposed to be closer to 20%, but they're actually probably going to come in around 10 to 12 or 10 to 15%. So I just want to give an update on the tariffs. They're not as bad as originally proposed in Liberation Day. They cause slight inflation, but we haven't seen a ton of it. But maybe that's because the data, we haven't seen the most recent data, but we will. They're not going to be, immediately inflation negative. They're not going to push inflation rates down. They will ultimately, because if they do produce higher inflation, then they'll produce lower growth, and lower growth will cause a cycle and a path dependency that would allow inflation to come down. But the immediate effect is higher prices. Just to talk about, again, some of the issues, is the Supreme Court going to rule in favor of the tariffs? Could go either way, actually. The poly market says there's a 26% chance. I actually think it's higher than that, that they do rule in favor of the Trump tariffs. They've indicated that they're sympathetic to the idea of a unitary executive. Whether or not Lisa Cook's going to get fired might depend on whether she gets charged federally. She's not going to be. It's not likely she'll get removed. The Fed is different. I want to talk about affordability just for a second, and then we can get into portfolio positioning. This is housing affordability versus the median income. Going back just 2 years ago, as the mortgage rates rose very swiftly, and before incomes caught up. That is, what happened was mortgage rates adjusted to the inflationary environment, but it took a while for wages to catch up. So you had an incredibly unaffordable period of time for the last 2 years. This is most certainly contributing to the very low consumer confidence and the angst that a lot of consumers feel. There's a couple other prices we'll talk about in a sec. All prices are higher, and this is not a great scenario. But it's if you look at median incomes, they're recovering. So this measure is starting to look a little better. Just looking at home affordability in terms of home prices and mortgage rates combined, they're still incredibly unaffordable, especially for first-time home buyers. First-time home buyers have less than 70% of the income they need to get into a house, whereas the broader composite is right about at that level. So very unaffordable housing situation. Julian, did you have a question?
No, I was just going to say, before we go to portfolio positioning, we still have a quick section to cover Fed policy, and we just got a 25 bips cut. And now, I guess, what's priced in for 2026? What should we think?
Get right to that. So let me finish up on affordability, because frankly, the rates of inflation and the Fed policy are very, very tightly linked. Here's a CPI index number. What you've got is this COVID massive spike. CPI average, the consumer price index, averaged 2% for 20 years, but for the last 5, 4.5%. This is the big move up that's causing consumers some angst. And by the way, it's also finding its way into mortgage, credit card, and auto loan rates. So mortgage, credit card, auto loan rates, they're on 2 different scales here, but in terms of just kind of looking at where they were in the 2015 to 2021 period, they're clearly a step function higher. And so these are the things that are going to be pretty big issues come and relate to affordability. Let's talk about the Fed. So when looking at the Fed, we think about the Taylor rule. We look at Fed funds deflated by the personal consumption expenditure index, and we also look at current Fed funds versus what we think is the neutral rate of interest. The Taylor rule is a model that should help us understand where Fed policy should be. And right now, the Taylor rule is telling you that with the rate cut yesterday, the Fed's at neutral. So that's good indication that we're normalizing. Another good indicator that we're normalizing, but we don't really have the most up-to-date information on the PCE core, is PC Fed funds minus the inflation rate. And right now, with a 363 Fed funds rate, that's the new target, is 3.5 to 3.75. So 363 is the mid. The real Fed funds rate at 80 basis points is right smash packed in between what we think is the new normalized or the old normalized monetary policy. So this indicates we're kind of in a neutral spot. And then when looking at what actually is R star, well, we're kind of in between the 2 expectations for R star as well. So all points suggest that maybe the Taylor rule, Fed funds, is kind of inclusive because we don't have we can't deflate, we don't have the real deflator, but everything points to a pretty neutral Fed. Julian, question?
I guess the question is, should the Fed already be at neutral and not have still a restrictive policy when inflation is still above their 2% target, where we're averaging more than around 3% at the moment?
Yeah. So like I said, I think the Fed is comfortable. So it's a couple things. The current inflation rate has something to say about what Fed policy is, but the Fed policy works on a 12-month lag, plus or minus. So the Fed is actually going to move to or skate to where the puck is, if you know what I mean. So the Federal Reserve is looking at the inflation dynamics and labor market dynamics, and they're seeing some cracks in the labor market, which will ultimately cause inflation to come down. If the labor market's tight, inflation goes up. If the unemployment rate is increasing, which means the labor market is getting a little squishy, then inflation tends to come down. So they may be neutral. They were slightly restrictive before this cut yesterday by most measures. Now they're kind of neutral-ish. They'll go further. They'll go below neutral in 2026 if they need to support the labor market. So that's the dynamics that I think we're seeing in the Fed. The way to think about what the Fed's going to do in 2026 Tell me if the labor market, if the unemployment rate ticks up from 4.4 to 4.6, then they're going to cut rates. If it goes from 4.6 to 4.8, they'll cut rates 3 times. That's a pretty good rule of thumb, I would say, even if inflation is a bit above, because, and I'll say it again, a little whiff of inflation here, bad for consumers, bad for consumer confidence, bad for affordability, really, really good in terms of liquidating the mountain of debt that we have on the books at 37 trillion of a national debt, and deficits that are growing at 6 or 7% for as far as the eye can see. So inflation is the anecdote for one problem, but it's not free, and it causes affordability issues across the complex. Okay, what's the Fed going to do? 1 in 4 chance, or 1 in 4 chance they cut rates in January. They're not going to cut rates in January, unless you get some data that comes out that catch-up data on inflation, or a labor market report that shows that the unemployment rate is spiking higher. I would put this is probably aggressive. I can't imagine. Maybe March and April. And if they don't cut in January, then this 1 in 4, 1 in 5 chance will just move to the next FOMC meeting. So there's 8 FOMC meetings every year. There will be 8 in 2026. By year end 2026, the last meeting is a year from earlier this week, December 9th, 2026. There are a little more than 2 rate cuts priced in. That's what the market's telling you. And here is the same data by looking at the futures, Fed funds futures. So rate hikes, not on the horizon. Rate cuts, did I say hikes? I meant rate cuts. Rate cuts, 2 more rate cuts are expected, maybe 2.5. The Fed's been using the balance sheet a little more effectively in order to solve a couple of problems. The first problem they needed to solve was some cracks in the liquidity related to overnight funding rates. And when you get a spike in the SOFR, or secured overnight funding rate, it generally means that there's a lack of liquidity. The Fed can fix that very quickly by buying a bunch of Treasury securities, primarily T-bills. That's not called quantitative easing, but it does increase the Fed's balance sheet. And it could be a form of quantitative easing if they bought more than T-bills. Like if they bought 5 or 10 or 10-year Treasuries, that's more akin to quantitative easing. If they bought 10-year Treasuries, by the way, it would do a lot of good to push down mortgage rates. But it also is accommodative, and it would cause inflation to spike. If you're a central banker, this is the dilemma you have. You'd like to keep interest rates low, but you can only affect the front end unless you use the balance sheet to buy 10-year notes, and then you can lower and flatten the curve. You can lower rates on the front end by decree, and then buy 10-year yields to flatten the curve instead of allowing the curve to steepen. And that's good, all good. So the balance sheet's likely to be used a little more effectively going forward, and it's going to be used almost immediately to fix a problem in overnight funding rates. I won't belabor that. I'll just go right to the Fed balance sheet slide. I mean, this is the monthly change in the Fed's balance sheet right here. You can see, for the most part, you've had a quantitative tightening period. The size of the balance sheet has been on this slope of a decline for the last 3 years. But now we're at kind of the steady state, which, if you just draw a line through where maybe the balance sheet should have been, absent the post great financial crisis malaise, and frankly post the COVID sudden stop in the U.S. economy, this is kind of the path we should be on. So the Fed's going to move the balance sheet up and down, and I think they'll probably get back on a growth path soon. Any questions on that? Thoughts? There's a question about whether the Fed will remain independent. It's likely that Kevin Hassett will be the next Fed chair, and it'll likely be announced in January. It's very unusual to have a Fed chairman coming right from the White House to an independent agency. That's never happened before. But he's qualified. He's an economist. And he's not alone in making decisions. It's a collaborative effort, and frankly, everyone has the same vote, even the chairman. The chairman's job is to corral the team. But even with a potentially more dovish and possibly partisan head of the Federal Reserve, I'm not going to say definitively that he will act in a partisan manner, because I don't know Kevin, never met him, but for the most part, the folks that are aware of this that I speak to aren't concerned at this point. If Lisa Cook gets removed and before February, there's an interesting implication there, which we don't have time for, but I'd love to talk to anybody that wants to talk about how the FOMC is composed and what the Federal Reserve Board's responsibility is for approving and vetting the regional bank presidents. They do have that in their remit. There could be scope for greater influence if a couple of other things happen, but just having Kevin Hassett be the chairman is not going to move the Fed from an independent central bank to a not independent central bank. You'll know, by the way, higher inflation expectations is a very definitive piece of evidence to suggest a loss of credibility. Okay, let's see. Let's go to the most important price in the world, and then we can talk about. We'll go right to positioning. This is the 10-year yield. Back in Jan, it peaked at 480. We're at 414. As long as interest rates continue to come down, and they should. I mean, Fed's lowered rates 75 basis points in the 10-year in 2025, and the 10-year yields come down 80 basis points, about the same amount. So, I mean, right now the Fed looks credible and everything's hunky-dory, but you are seeing some pretty unusual activity in 10-year Japanese yields. So this is something we're keeping an eye on. And at 2% 10-year yields in Japan, you haven't seen that in 25 years. Global interest rates will put a floor under how low U.S. Treasury yields can go, and that's why we keep an eye on UK, Germany, and Japan 10-year yields. So I'm not going to talk about politics to any great degree. I will highlight some of the macro implications: immigration, trade, cost-cutting, Federal Reserve, and taxes, and deregulation. We've already talked about how some of these policies are growth positive, growth negative, how some, if you add policy uncertainty, if you nix policy uncertainty, it actually makes things a little better looking in terms of growth and inflation. And that's where we are. We moved from negative growth environment where the recession probabilities spiked up to 40%. But that started to make inflation look better, because if you're in a recession, inflation looks better. There's no progress on the debt and deficit, and that's the same in this environment. But there's a little better. You can have a little bit better view of debt and deficits if growth is higher. So this is just a summary of how the current administration's policy priorities are playing out, and I don't think there's anything new there. I would talk about the midterms, except we are just under a year away, and no one's going to be able to make any strong case for who's going to take the House, or if the Republicans can retain the Senate. That's the big battleground. Signs so far are pointing towards, like they normally do, a resurgent. Yeah, Neil, we can get you one. A resurgent Democratic confidence in maybe wresting control of the House because of some results in the New Jersey and governor and Virginia governor elections, and frankly the most recent Miami mayoral election. So there are some cracks in what was a fairly monolithic Republican victory a year ago, but it's way too soon to tell. And it doesn't really matter for markets to the extent that all we want to know is what are the policies that are going to be implemented, which is why we focus on charts like this, identifying the policies. Now, politics matters because then you know what the policy priorities are. What can be implemented is a function of who's in control and how durable those policies will be. So it's not completely off the table when we're talking about investments and investing. It's just not the most important thing. The most important thing is, over the course of the next year, understanding that every administration that's in power wants to remain in power, and they will use all the tools of government to try to remain in power. And that this administration has been notably more aggressive, perhaps, than some in the recent past, but it's not unusual.
Okay, Michael, we have about 10 minutes left and a lot of questions on portfolio positioning. So, I mean, I guess with spreads pretty tight in fixed income and high valuation in equities, how do we think about positioning for 2026?
So heading into 2026, the big picture, which goes actually beyond the next 4 quarters, has to be viewed as one of again, a balancing act. And if I had to pick what the most important drivers of economic growth and hence as capital market returns will be, it has to be this group of known headwinds, which includes the 3 Ds that we've talked about: debt, demographics, and the reshoring and deglobalization, that were all 3 big drivers of economic growth for the last 40 years, when we had low debt levels, when demographics were more favorable, and when deglobalization was actually globalization. So now that many of these former tailwinds to the economy are in reverse, and they're knowable, you know exactly how many 30-year-olds are going to be in the United States today, 30 years from now. Debt levels, you just have to look at, the clock in Times Square or whatever. It's got the 37 trillion on it. And deglobalization is an obvious policy priority of the current administration. The hope is that this AI becomes a little weightier. And I think that's what we're seeing right now, is that for the most part, market participants are looking at the productivity enhancing benefits of AI and saying they're going to outweigh the 3 Ds. And that's fine. But that's an unknown right now. So that may set the stage for some volatility in 2026. We're not escaping it. We saw a couple of bouts in the end of the third and beginning of the fourth quarter. And that's just indicative of the fact that this is very finely balanced between the headwinds and the tailwinds. But again, the known issues relate to, debt. This is economy-wide debt to GDP. And it's just taken a bit of the slope of this line, which, by the way, is primarily federal government debt. You can see that the orange bars, which is U.S. Treasury debt, is the thing that's kind of taken off here, along with a little bit of household debt bumping up, but mostly it's federal government debt, and that's fixable painfully with higher taxes and lower services and expenditures. And again, there isn't a politician out there that's ever going to get elected on that platform, but that's what we know. Debt levels are a problem, and we should just keep them front of mind. But looking at the macro forecasts for 2025 versus 2026, there's GDP, inflation, unemployment, and central bank policy rates. Central bank policy rates are going to come down in the U.S. versus the Eurozone, maybe less so China, but that is likely to push the dollar down a little bit, or at least the effect of this element, central bank policy, is a weaker dollar. But in terms of global growth, pretty benign. Global inflation coming down a little bit. The unemployment rate in the U.S. ticking up. It would be great if we stopped at 4.4. That would keep the Fed maybe on pause, or maybe one more rate cut. But if we get to 4.6, 4.8, the Fed's going to have to cut rates a little more. Eurozone unemployment static, and China unemployment. It looks pretty benign. So how do we translate that into equity market returns? Well, just taking a survey of the investment banks from Morgan Stanley to B of A and Goldman, Oppenheimer we include because they've got the highest of a 17%. We're at 68.86 on the S&P right now. And Oppenheimer's predicting another double-digit year, as are Morgan Stanley and Goldman. This is not surprising. Julie and I were talking about this earlier. I don't think we've ever seen an investment bank that had a lower, a S&P decline year over year heading into December. So 8,100 to 7,100 are the targets of most of the investment banks. There might have been one below or one kind of flattish, but for the most part, this is what investment banks do. These are highly consistent with a reaccelerating economy. And I'm just going to finish real quick here with what's the outlook for the 10-year yield? 10 years at 4.10. Most folks think same or a little higher. Transamerica, again, don't follow them as much, but they've got a 35 basis point lower 10-year end of year target for the 10-year Treasury. So the way to think about it, I think, is this: probably unless you get an economic slowdown of any great magnitude, the economy looks pretty solid, unless you get an exogenous shock. And if so, then all bets are off. But if it's business as usual, another 5 to 10% year in the equity market doesn't seem outrageous. and another one, maybe a Fed rate cut, maybe two. I'd summarize it maybe like this. The economy is likely to get a pretty good boost. Maybe it fades in the second half, but we'll already have some, credit put in the bank for the first half. So another 2% GDP year doesn't seem outrageous. Inflation stabilizing at slightly higher levels. Fed to cut rates once, maybe twice. I don't know. It seems pretty benign. I'm going to skip to the positioning portfolio unless there's a question, Julian.
I guess I was going to ask more about the long-term expected return for equities. I guess we've had almost double. They were pretty much valuation have doubled in the last 3 years. So from here, what can you expect in terms of long-term capital market assumptions for equities?
Lower. I mean, it's hard to say. If equity values, as we've discussed many times, are a function of where the economy, interest rate environment, and hence corporate profits. And if interest rates can't continue to go lower, which would expand the multiple, corporate profits, though, the downside is negative and the upside is infinity. So if AI somehow causes a regime shift in productivity, then you could see long-term capital market assumptions for equity returns go higher, but that remains an unknown. So our best guess today is that if you've got 3 years of 20% kind of equity market returns, to expect another one is asking a lot. But I would have said the same thing 12 months ago. So it's hard to predict. And our job is not necessarily to get it exactly right, but to make sure that clients are properly positioned to weather the storms that are inevitable and to be exposed to enough of the equity market risk so that they can build wealth. Yes, if you have a short-term down re-rating, in a negative drawdown in equity markets, that feels terrible, except for one thing. From these levels, you're still, if the market dropped by half from here, you're still a double from 3 years ago. It's really important to remember that it's not really relevant that we look at a drop from 6,800 to 5,000. The way to look at it is 3 years ago, the S&P was at 3,500. So you still got a 50% upside. It's going to wiggle around the long-term trend. What's the long-term trend? I'd guess lower, but AI could be a real positive surprise here. So this is a more granular summary of how we're positioned and will remain so. We do have another macroeconomic and asset allocation meeting coming up in less than a month. And when we get together then, these might change slightly, but I don't think so. Value still seems like a value. Large cap still seems pretty attractive. So non-US with the dollar continuing to feel a little squishy might outperform again. I think the Fed funds are near normal. Long-term yields elevated around 4% plus or minus. No big changes there. The most important thing, and it's always there, is to remain invested broadly. And if you have the capacity to give up some liquidity, make sure you've got a strategic allocation to alternatives. They will serve you well in a downturn. Any final questions, Julian?
Yeah, I was going to ask one last question that we've had a few times. I guess what can we do? What do we do, Beacon Point, to help portfolios, in down markets, or if there's a crash, how do you insulate that from?
You don't. Nobody does. Anybody that says they can insulate a portfolio from the normal market cycles is going to put you in a portfolio that doesn't participate fully on the upside. And I think this is an important slide to highlight why you want to be fully invested all the time. It's mostly upside. Take the downside. Don't, it's not necessary to get too concerned about the downturns. It feels bad in the moment, but if you can take a step back and look at the longer term, the green are bull markets going back to the 1920s. The orange are the bear markets. And the size of the boxes are representative of the wealth that's being built or the wealth that's being destroyed. And there's absolutely no reason to believe that this same sort of structure wouldn't persist in the future. So prepare mentally for the next minus 25. It's going to happen. You're in a portfolio, by the way, the stock market's down 25%. Your portfolio, if you're in a 50-50, 60-40, 70-30, you're only down 10 or 12, whatever. So everyone can take that, especially given the run we've had. So I think you got to average. You got to average it. You can't just look at one data point.
Now, I was going to say we actually almost got a 19.5% drawdown in April, and that was not that long ago, but it was gone within a month.
And again, these are the kinds of exogenous shocks. That wasn't persistent. It lasted about a cup of coffee. Yeah, it's challenging to remain sanguine about drawdowns. Most people don't do well with that environment, and that's because you're human. I mean, but the fact is, you've got to be able to step back and look at the longer term and realize that investing is not a calendar year exercise, or a day-by-day exercise. True investing, requires a 5-year investment horizon minimum, 10 to 15 better. So with that, if you have further questions, if there's anything else that isn't time sensitive, we're going to have to wrap it now. We're at 60 minutes. Anything else, Nick or Julian? If not, I'll just say thank you to this group for joining. We really appreciate the time that you spend with us and all the questions. They're excellent questions. Keep them coming. If there's something you didn't get answered, don't hesitate to shoot it over to your advisor or to your institutional consultant, and we'll be happy to get back with you. Thanks again for being Beacon Point clients and to be on the call today. Thank you, and we look forward to speaking with you again in February. Julian?
Yeah, thank you, Michael, and thank you all for joining us today. I just want to add one thing. So we'll have our next quarterly update on February 12th. So you will receive an invite in your inbox, but you can already write that down. And then I guess we look forward to seeing you then. Until next time, à bientôt.
Bye now. Thank you.
Thank you.